Monday, September 23rd, 2019, Maneco 64, home of alternative economics and contrarian views. So when the head of the Economic and Monetary Department of the BIS, which is the bank for the central bankers, right? I've spoken about the BIS many times before. When he says that the bond market and all the negative yielding debt is very troubling, you need to listen. And also when the FT is saying that central bankers are flying blind, we need to listen. That's what I want to talk about today. We've come to the end of the game, from, in my opinion, of the Keynesian experiment. What's the Keynesian experiment? Well, basically is the idea that a group of people, an elite, can actually run the economy and use government spending, taxation to control everything. It's part of the PhD economics, right? That all you need to do is jig the numbers around. And I think these negative interest rates are part of that. The fact that they think, oh, if we drive interest rates to -2, that should help GDP. But they don't think of the human consequences like the Austrians do, the human action. They think the economy and the general public are just like pawns. And they think they can, it's like a math equation, right? That you can move around. And I think what we're seeing now is the realization that that's not so. Look at Europe. They've had negative interest rates, loads of QE, and nothing to show for. The Federal Reserve, the US as well. Over a decade of easy money. I know there had been some tightening prior to this year in the US, but they can't tighten. We saw last year they started tightening. People were talking even late last year that we're going to have another three rate hikes this year. And what we had this year, 2 rate cuts, right? So this is what I want to talk about right now. I'll look at the markets at the end today. So there's a couple of articles here. The first one I want to look at is in the FT, and is by Gillian Tett of the FT. And believe me, I subscribe to the FT. I know it is a globalist publication, but it's good to read what these guys or these girls are talking about, right? Because if even they are saying these things, there must be trouble. As we've known all along, people like me have known for many years. So she wrote on September 19th, the repo market mystery reminds us that we are flying blind. Quantitative easing means there is a greater chance of the global financial machine misfiring. Yeah. And she goes on about what happened last week, right? Which you should know by now, having listened to my videos last week. And if you haven't, go to my channel and look at the different videos for last week. It's all there about the repo and what's happening. So this is the interesting part here of this article. I won't go through the whole thing. It says a decade of extraordinary monetary policy experiments has left the system badly distorted. So before I continue with that, yes, we all talk about it as extraordinary, unconventional monetary policy, but it's not. Really, in the end of the day, it's just a load of money printing, right? It's a load of stimulant and drugs to the system, and it's very difficult to take that drug out of the system. That's why we're having the trouble, right? The other thing I would say, it's helped governments, like in the US and the UK, not so much in Europe, but definitely in Europe as well. It's helped them remain, how can I say, profligate. I do know that countries like Germany and Holland and Switzerland do run small surpluses, but countries like Italy, Spain, Greece, they should have gone bust about 6 years ago. Their interest rates, don't forget, were at 8-9% the 10-year back in 2012 before Draghi threw everything at it, right, to save the euro. And now the 10-year Italian is less than 1%. So that keeps governments dishonest in terms of spending, right? So she continues. She says, thus the Fed is now like a pilot flying a plane with an engine that has been stealthily remodeled. Neither the passengers nor the pilot knows how the engine's shifting cogs might affect the controls during a wave of turbulence. Because there's little historical precedent. Well, actually, I think there is historical precedent, Ms. Tet, and that's the Weimar hyperinflation, right? So what does she say at the end? This is unnerving, but the bigger point that investors need to understand is this. The more that QE and its partial reversal reshapes global finance, I don't think it's reshaping a global finance, by the way. I think it's destroying global finance. The greater the risk that the cogs in the machine unexpectedly misfire. There's no reason to panic. Wow. But the central bank pilots, like investors, are learning on the job. Better hope they stay completely alert. Well, I think the plane's going to crash, Miss Tet. I think it's great that you're so optimistic, but there you go. That's the first one I wanted to talk about. And then there's another one in Zero Hedge. It came out on the 20th. It says, a clueless New York Fed is examining why banks with excess cash fail to halt repo panic. This is talking about how the head of the New York Fed, Williams, is clueless, right? He doesn't seem to understand why the banks are not lending to each other. He doesn't realize the fact that the Fed took out, I think, over $1 trillion of reserves from the system by unwinding their QE. That's why this is happening now, right? And this is what this article says. What is troubling about that statement is that it is precisely the level of reserves that the New York Fed should be focusing on. After all, that would justify their repo deep freeze, as it has now been abundantly clear that the U.S. financial system will need about $400 billion more in reserves, but not how the market functions. If anything, that's one thing the New York Fed should know by now. Yet the fact that the career economist Williams admits that the Fed is clueless about the market plumbing is extremely concerning. So there you go. I'll put the link to this article below in the description if you want to read the whole thing. But so FT, Zero Hedge, very different organizations, both saying the same thing, right? And now to the head of the Monetary and Economic Department at the BIS, Zero Hedge's come out with this as well. It says vaguely troubling. That's what he says. His name is Claudio Borio. BIS warns of financial disaster amid 17 trillion in negative yield debt. But his solution, of course, is for governments to start spending again, which won't solve the problem. Because the reason the economies don't do well is because the governments are crowding out the private sector. What do you think all the debt that the government takes, that's crowding out private investment? So this is what he says, this guy, Borio. The room for monetary policy maneuver has narrowed further. Should a downturn materialize, monetary policy will need a helping hand, not least from a wise use of fiscal policy in those countries where there is still room for maneuver. Well, I can tell you, yeah, there's room in Germany and Holland and countries like that, but I don't think they're going to indebt themselves even more to help the rest of the world. And it's funny, I think someone said a few weeks ago, or Paul Krugman, He was having a go at Germany, saying that they were running a ruinous fiscal policy. The fact that they're actually saving and paying down debt, he's calling that ruinous. So that's the PhD mentality. That's not going to help either. Increase fiscal policy. It's not going to help. What's going to help the world to be, at least the Western world, to get kind of reset into a better economic path? Well, I think it's the collapse of our monetary system, our banking system. They're all like rotten. We need that to complete collapse of that. We need to see the banks that were supposed to have gone bust in 08, 09, all the big Wall Street banks, all the big London banks. We need to see them disappear. We need to see something new. We need to see a mentality where people believe in themselves, and also, how can I say, don't think that government is the solution to everything. So we need to see sound money, sound banking, small government, and not all this dependence on this Keynesian PhD economics. So basically, we need to see more of the Austrian spirit, Austrian School of Economics spirits of free markets, small government, and sound money. Until we see that, I don't have much hope. How do you protect yourself in an environment like this? Well, you look after yourself, your family, and you try to keep a little bit of precious metals if you can, gold and silver, to protect yourself against this crazy world of money, this fiat currency system, fiscal madness. Yes, that's the only thing you can do. So there you go. PhD economics, Keynesian economics, driving the world into a corner. Now to the markets. Just quickly see where we are this morning. It's 10 to 8 a.m. London. We've got spot gold down a couple of dollars at 1513.68. Range has been 1510 to around 1520 this morning. So it's continued to go higher, gold. It closed quite well on Friday. But the interesting precious metals this morning is actually silver, which is up 1.5%, or almost 30 cents right now at 1826. We got up to 1836, and the high has been 1791. So that is encouraging to see silver leading the way again. We'll have to keep an eye on that. The Dow had a bad close on Friday. Stock markets closed down 0.5%. Right now it's up 90, or a third, at 27,021. S&P is up 11, just above 3,000, 3,001, up a third as well. NASDAQ 100 futures up 0.5% at 78.53. Still think the longer term picture from the beginning of last year in the stock market doesn't look good. I think we're forming a huge, massive 2-year top. I don't think it's going to end well for the stock market. The pound is down 0.2%, 124.46. Euro is unchanged, 110.16. Dollars up 0.16% against the yen, 107.73. And the dollar's down 0.16 versus the yuan at 710.89. Oil price is up just under 1%. WTI 58.64. Brent is at 64.05. So still quite elevated oil prices. The bond market, we've got the 10-year yield at 175. That's unchanged. And the 2-year at 172. So the curve has disinverted for now. What should we look at this week? Well, we've got the manufacturing PMI in the States today. Later on today, that's going to be an important number. I think Mario Draghi is going to be speaking to the EU Parliament this week as well. I'm not sure if it's today or tomorrow. Keep an ear out for that. And let's keep an eye on this repo market. The Fed, of course, announced late last week that it's going to do a repo, overnight repo every day until October 10th, and it's going to do another 50 billion of 2-week repos as well. So let's see what happens. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.